How Wall Street is crashing the housing market. Despite controversies in the industry, Wall Street is turning its attention towards investing in single-family rental homes, as the demand for these properties continues to rise. This is due to several factors, including the preference of renters for standalone homes over apartments, low mortgage rates, and the use of big data to manage and assess these properties. But market analysts think several other factors could be responsible for this trend. Could it be due to increasing property values or improved technological capabilities? Why are properties being purchased by Wall Street? The real estate market is nothing new to Wall Street. Together with other scalable commercial properties including office, retail, and industrial buildings, multifamily rental properties have traditionally been regarded as a core portfolio item for institutional investors. All of these are capable of recouping the significant capital investments made by these organizations to obtain them. However, because they are more challenging to scale, single-family rentals were typically categorized as non-core, grouped alongside with specialty assets like data centers, medical offices, hotels, and senior housing. That's no longer the case. Thanks to technology, more than only single-family rentals are being transformed by property technology, but the effects there are particularly notable. Single-family properties are more idiosyncratic than multifamily properties, making the due diligence process for prospective buyers more expensive per unit. Multifamily properties' due diligence is, by definition, already scaled. What has changed is that investors are using big data technology to quickly filter due diligence information, bringing increased efficiency and accessibility to markets that were previously fragmented. Goldman Sachs-backed niche businesses like Intera have arisen, utilizing technology to analyze property records and other data to assist investors in swiftly identifying real estate listings that match their purchasing requirements and aiding them in determining the appropriate bids. Institutions can scale their property holdings and get more precise return estimates for their models because of these capabilities. How technology is increasing demand for single-family rentals. Of course, technology can't address every real estate issue. To flip single-family homes, a new class of investors known as iBuyers took the role of automated decision-making to its logical conclusion by using computer algorithms to carry out purchases and sales. This strategy failed miserably for the company Zillow. Zillow, which is most known for publishing real estate listings online and estimating property values, was forced to halt its new purchase and flip program in November 2021 and list 7,000 homes after realizing it grossly overpaid for properties. We use technology in every aspect of our business, everything from acquisition through maintenance, and into the call center to improve our operating metrics and offer residents a much better experience. Gary Bierman, the chief executive officer of Tricon Residential, spoke to the financial news provider Seeking Alpha in October 2021. 33,000 properties are managed by Tricon Residential throughout North America. This market has become more appealing for a variety of reasons, including the Federal Reserve's ongoing monetary easing, which helped drive up the real estate prices. Nevertheless, having once led a fund that invested heavily in single-family real estate, I believe the most relevant component is the development in big data, which significantly improves the ability of investors to undertake due diligence and foresee trends. These new home rental companies can scale and manage their portfolios more effectively thanks to the dramatic increase in computing power. These investors are probably here to stay as a result of the confidence of market conditions and improved analytical capability. Aggressive single-family property acquisition. Before 2010, large institutional investors typically avoided the single-family rental sector because they preferred easy-to-scale multifamily buildings. But since the financial crisis, and especially after 2019, that's changed. More than 24 single-family home rental companies have received funding from financial heavyweights like JP Morgan Asset Management, Blackstone, and Goldman Sachs Asset Management to help them buy existing properties and construct new ones. In the third quarter of 2021, the number of residential properties purchased by businesses or institutions increased to 90,215 residents, with both big and small investors making up 18% of single-family home sales. According to the online real estate company Redfin, that is an increase of 80.2% from the previous year. Single-family houses accounted for over 3/4 of the residential purchases made by investors, while multifamily homes, a market in which investors have long played a big role, only made up 1/4 of transactions. One factor contributing to the rise in single-family housing prices and rents across the US today is the entrance of this institutional capital. And despite unfavorable media attention, rising rents are luring even more investors. While making a profit is undoubtedly the aim of investors, the changing market conditions that have made single-family houses a desired holding have ramifications for all models used to make investment decisions, as well as the distribution of assets across investors' portfolios. Real estate market influence on Wall Street. Yet, it's still unclear how much of an impact Wall Street-backed companies will have. According to experts with broker-dealer AMHERST PIERPONT, which specializes in fixed-income capital markets, they currently make up barely 2% of the entire residential market. Moreover, this class can have some built-in restrictions. Companies that rent out single-family houses frequently concentrate their efforts on the western, southwestern, and southern states' faster-growing regions, purchasing and constructing properties that primarily appeal to families in the middle and upper middle classes. Because of this and other constraints, build-to-rent has come to the forefront of investors' attention. Nonetheless, investor acquisitions are still happening quickly. A record amount of debt secured by single-family rental portfolios has been issued as a result of the general recognition that due diligence procedures could scale, which increased liquidity for institutional financings by spreading the risks. According to AMHERST PIERPONT, the total public issuance of so-called SFR debt in 2021 hit a record $43 billion. While SFR securitizations have been increasing over time, they have recently increased significantly because of the ease with which these properties can now be vetted and managed thanks to big data and automation. Unlike owner-occupied homes, which are typically financed with 30-year loans, SFR portfolios are usually financed with shorter terms, similar to commercial real estate. When it comes time to sell or refinance, a significant increase in interest rates could eliminate the net rental yield. The industry sees SFR debt in a similar light to the inherent risks of commercial mortgage-backed securities. Variability in home maintenance and upkeep, which may potentially reduce cash flows, is another problematic element. If interest rates and maintenance expenses increase enough, there's a chance that a rush of investors selling into an unliquid market would drive prices down and mark down debt, forcing sales as we witnessed in 2008. Given all of these elements, we anticipate an increase in SFR securitizations. The first complete cycle of this particular securitization boom began in 2021, and since then, the performance has been excellent, trading on par with other structured debt. Because rents are rising and investors believe that risk and interest rates will remain low for the foreseeable future, Wall Street is eager to originate as many securitizations as investors can eat. At this time, Wall Street's appetite for more single-family homes is great, yet there are dangers to be aware of, with interest rates prominent among them. Do you think this voracious appetite is anything other competitors in real estate development should be anxious about? Please let us know your thoughts in the comments. Subscribe to our channel and turn on the notification bell for more videos like this.